Ladies and gentlemen, students, gather round for your mind to be blown. Today, I'll be explaining the accounting concept. Drumroll please, petty cash. Now buckle your seatbelt and prepare yourself for the next best 3 minutes of your life. Now, petty cash, what even is that? Well, by definition, a petty cash fund is an amount of cash kept on hand to pay for minor expenditures. But what is petty cash used for? Well, it can be used for paying for postage for small mailings and or perhaps the purchase of miscellaneous office supplies. Petty cash is done through the following 3 activities. Step 1, establishing the fund. Step 2, making payments from the fund. Lastly, step 3, replenishing the fund. Okay, so establishing the fund. What does that involve? It's pretty simple, really. It only involves 3 steps. A petty cash fund is established by firstly writing a check for the amount of the fund, and then chasing the check, and next placing the cash under the care of an employee that has been designated as the custodian. We'll call him Tom. Once done, the next step is to create a journal entry that ultimately records the establishment of the fund. Let's quickly look at what a journal entry may look like with petty cash, as demonstrated in the ACCT 3-year financial textbook through Bianca's Chocolate Shop. On the 1st of May, Bianca cashes a $100 check to establish a petty fund and gives the cash to the custodian Tom. This would be her following entry. As you can see, the entry increases petty cash and decreases its cash. Now, before you panic, let me break it down simpler. Bianca's Chocolate Shop has quite simply just designated $100 to be used in a petty cash fund. They still have its cash, however, it has not yet disbursed any cash outside the business. The next step involved in the operation of petty cash is making payments from the fund. After the fund is established, the cash is used for paying for qualifying expenditures. These payments are made in one or two ways. Firstly, cash can either be taken from the fund to make payment, or employees can seek reimbursement that they have personally made. Whichever payment is used, it is really important that the custodian should collect receipts and authorizations for the use of any cash. However, folks, just remember that as payments are made from petty cash, no journal entries are made. Journal entries are only recorded when the fund is replenished. Now, the last step involved in the operation of petty cash is replenishing the fund. As expenditures occur, it's pretty obvious that eventually the cash in the box will be depleted. Thus, the fund must be replenished. To do so, the remaining cash in the fund is counted in the business cash as a check for the amount. That brings the total cash in the fund back to the original balance. At the same time, receipts are removed from the petty cash box and formally recorded as expenses. So what if the required replenishment amount and receipts don't match up and there is a discrepancy? This is where the temporary expense account cash over and short comes in. Cash over and short is a temporary account that can either have a debit or credit balance depending on the situation. Occasional errors may cause a petty cash fund to be out of balance, such as math errors, or perhaps someone failed to provide a receipt for an appropriate expenditure. In some cases, employers are issued with a business credit card and are required to justify and receive authorization for any purchases after they are made.